So goodwill has a couple of different meanings in practice. Generally speaking, goodwill's deemed to mean a favourable reputation you might have with your customer base. But when we think about it from an accounting perspective in particular, we generally take a broader meaning to it, and we talk to things like favourable contracts with suppliers or your brand or things like that. When we look at the definition of goodwill in the accounting standards, and it's contained in the business combination standard, the definition talks about economic benefits that can be derived from assets that can't otherwise be individually identified or separately measured. And the key point there is that while goodwill is a separate concept, it's not something that's valued in of itself. It's a residual concept after you've gone through a process of valuing everything else that you can separately identify. And that's quite important when you approach a business combination and what we refer to as the purchase price allocation, which is the process where you involve the valuers to go through, first identify all of the assets and liabilities associated with the acquisition and attach a value to those separate assets and liabilities. And then any difference that arises between all the identified assets and the purchase consideration is goodwill. That also means that by definition you can only have goodwill arising from a business combination. It can't be internally generated by spend that you incur as a business creating those items of goodwill. So given all that, goodwill creates some unique practical implications when you're thinking about a business combination and that purchase price allocation process. The first one is thinking about the risk of impairment post acquisition. Because goodwill is an indefinite life asset and is not amortised. There is some debate about that at the moment, about whether it should be amortised, but for now it's not. It means that annually entities that have goodwill will have to undertake an impairment test. And that can be quite onerous and add some risk of write-down in future periods. So the second thing is around the regulator's views and what ASIC would say about goodwill. So generally speaking, because it is a residual, the preference would be that as many separately identified intangibles are identified as possible. So if you've ended up with a large goodwill balance, it's probably an indicator that you have not identified all of the things that could be recognised separately and should go back and reassess that process. And then if you're comfortable that there isn't anything else, then you will have the residual as goodwill. The third element or practical challenge that I identify is the process of determining deferred tax balances in a business combination. Because goodwill will still have a tax base, there is a need to recognise a deferred tax balance in relation to the goodwill balance. But it can be a bit of an iterative process because obviously with goodwill being a residual, any deferred tax that is recognised will then obviously impact the goodwill balance. So in summary, what I'd say about goodwill in a business combination is that while it could be deemed unimportant because it is effectively the residual, there are very important considerations to go through in the process of undertaking a purchase price allocation.